Hi everyone, this is Professor Boucher, and today we're going to be talking about depreciation. So what is depreciation? Depreciation is going to be the logical application of the cost of a long-lived asset, say a building or a truck, to an expense. So you saw earlier what we had done when we purchased something that had a life expectancy more than the current period. We would do a process called capitalizing it, in which case we would go ahead and purchase it and then recognize it as an asset rather than an expense. Now, like most things we're going to use in our business, it's going to go ahead and get used up as we operate it. So as we go ahead and do that, we're going to allocate part of the cost of using up that asset to the revenue that we're generating. This goes back to the matching principle. The matching principle is where we say we should take our revenues and match them with our expenses. That helps a user of the financial statements better understand how we're able to generate our revenue. So now let's go ahead and talk about a few items that are going to impact what we're going to be working on for depreciation. The first is going to be the cost. So when we talk about top cost, we're talking about the historical cost. What did we pay for the asset? Now, it may include other items in that cost. Anything that we would be required to capitalize it, such as shipping, installation costs, things like that would all go into the historical cost of an asset. Then the next thing that we're going to be talking about is the salvage value. Now, the salvage value is an estimate. It's what we expect to be able to sell or salvage the asset for at the end. I use both of those terms because you're going to see them used interchangeably. And the last thing that we're going to need is the useful life. Again, this is an estimate. And what we're trying to estimate is how long do we expect this asset to be able to provide a serviceable life for us. So it can be measured in one of two ways. The first way, it can go ahead and be measured in time. 1 year, 5 years, 50 years, whatever we expect the asset to last. The other could be a units of production. So say we have a truck. If we have a truck, we're going to expect it to last, I don't know if this is a big truck, maybe 200,000 miles, maybe 500,000 miles. I'm not sure. But it's an estimate either way. And that's what's going to go ahead and go into our useful life, or what is sometimes called the service life of an asset. Now we're going to go ahead and jump into the practice for Chapter 10. So there's several methods that we could use to go ahead and calculate depreciation. The one we're going to be working on first is the straight line method. So let's go ahead and take a look at the problem. On this one, our company purchased a truck for $130,000. This is going to represent our historical cost. I'm just going to write it as cost. The truck is expected to have an estimated useful life, here's our useful life again, of 5 years or 125,000 miles. And the company estimates that the truck will be able to be disposed of at the end of its useful life for $30,000. This right here, in essence, is our salvage value. So let's begin with the straight line method. The straight line method is going to be the simplest method for us to use. We're going to end up coming up with one single amount of depreciation that will be recognized over the year. So we only have to figure it out once and we apply it evenly throughout the life of the asset. Let's go ahead and give it a try. What we're going to start with is our historical cost. Our cost on this asset is $130,000. And from that, we're going to subtract from it its salvage value. I'm just going to shorten that to SV for salvage value. In this case, it was $30,000. This means the amount that we are going to depreciate is $100,000. Now that we have the amount that we are going to depreciate, we will go ahead and take that and divide it by the years. Whenever we're doing straight line, we're going to use the years. We're not going to use the miles. So if you see a problem that says straight line, know that you're going to go exactly to years. So we know that we have $100,000 which is going to be the amount to be depreciated. And we will now divide this by the 5 years. So what we're going to have here, we are going to have $20,000. And remember, that $20,000 represents the annual depreciation. Okay, so the computation over here, this section would be for doing that math that I have up here. I drew it out, but we could draw that math over here. So our depreciation expense, that's what was determined right here. This is our depreciation expense for the year. It's going to be $20,000. Now, the way accumulated depreciation works, kind of like the name implies, we're going to use this to accumulate all the depreciation that we've charged as an expense to the asset throughout its life. The accumulated depreciation account is linked to a specific asset. That depreciation that we've recognized that ends up in accumulated depreciation ends up coming into the fact when we are calculating our book value. And we're going to see that in just a second. So when we're looking at the first year of this asset, we've got $20,000 as our depreciation expense. Again, since there was previously no depreciation recorded, the only amount that has been accumulated is the $20,000 that we are recognizing this year. Now let's look at calculating the book value. In the book value, we're going to take the historical cost of $130,000, and we're going to subtract from that our accumulated depreciation. For year one, we've only got $20,000, which means our book value for year one is going to be $110,000. Moving on to year two. Again, the easy and the nice part of straight line depreciation is once we go through the process of finding how much our annual depreciation is, we just recognize that amount every year. So year two, we've got another $20,000. Now our accumulated depreciation, this is where we're going to go ahead and add any of the depreciation that has been applied. So previously we had 20. This year we've added another 20 to it. We now have a total accumulated depreciation of $40,000. So when we go ahead and do our math to the right-hand side here, we had $130,000 of historical cost, and now we will subtract the book value of $40,000. And this is going to give us a book value at the end of year two of $90,000. All right, and we follow this process on through. So we've got 20,000. I'm going to move a little bit quicker now. 20,000 for depreciation, which means my accumulated depreciation is now 60,000, and my book value is now 70,000. Because again, our math would be 130,000 of historical cost, subtracting our accumulated depreciation of 60,000. Year number 4, still recognizing $20,000 of depreciation. Our accumulated depreciation is now $80,000, giving us a book value of $50,000. Finally, our last year, we have $20,000 of depreciation, making our accumulated depreciation $100,000, and our ending book value $30,000. You'll see that our ending book value that we have down here equals what the salvage value was up here. The next method we're going to take a look at is the declining balance. This is an accelerated depreciation method. So again, what we're trying to evaluate is how is this asset used up in the production of revenue. So straight line, that makes sense for something like maybe a building. It kind of depreciates evenly over time. Whereas when we get to declining balance, this is something we would expect to see that uses up a lot of its life at the beginning and it kind of trails off at the end. Think of something more like a piece of equipment. So let's go ahead and work on the declining balance. With declining balance, the first thing we have to do is find out what was the percentage decline using the straight line method. And to do that, we will take 100%, and we will divide that by the life. In this case, it is 5 years. That's going to give us a rate of 20%. Now in the declining balance method, we have to double what the straight line was. So we're going to go ahead and take that 20%, multiply it by 2. We're going to end up with 40% as our declining rate. Where we get a little bit different with declining, we're not going to go ahead and start with our depreciable value. We're going to go ahead and go right from the historical cost and work our way through. So the computation part in this one, I'm going to make sure that it ends up in each one of these computation boxes. So in the first year, we went ahead and our historical cost was $130,000. And we are multiplying this by our 40%. That gives us $52,000. And that $52,000 is going to be our depreciation expense. Now we're going to do the accumulated depreciation. Since accumulated depreciation is only being recognized in this first year, it's going to be the $52,000 carried over. Now to do our book value, we start with our $130,000 historical cost. We subtract out the accumulated depreciation of $52,000. And we end up with a book value of $78,000. And what we're going to do now, again, I'm going to be taking the computations here. With the declining balance method, we start with the book value from the prior year. So I'm going to start with the $78,000, which was my ending book value from the prior year. I'm going to multiply this by our 40%, which is going to give me a depreciation expense of $31,200. Since this is my second year, I have to go ahead and accumulate my depreciation on top of what has previously been recognized. So we are going to end up with $83,200. And one more time, I'll copy the math to the right-hand side here. We've got our $130,000 original historical cost, and we are now subtracting out the total accumulated depreciation of $83,200, which is going to give us a book value of $46,800. We're going to go ahead and take that $46,800 and we are going to put it over here, back in our computation. Now the part for declining balance that gets a little tricky, we don't take into account the salvage value at the very beginning, which means the salvage value becomes our stopping point. We can't depreciate this asset beyond the salvage value. So what we do is we recognize either the percentage rate for that year, or we recognize whatever would bring us to the salvage value. Whatever amount would be less. So let's go ahead and do the math on this one. If we took our $46,800 and multiplied it by our 40%, we would end up with $18,720. When we add that to our accumulated depreciation, we would end up with $101,920. I went ahead and I did my math over here. I take my $130,000 and I subtracted out the $101,920. I would end up with $28,080. So this is a problem because I can't go ahead and reduce this below my salvage value. So now I know that I can't do this one. I'm going to have to go back and redo it. Okay, so we know that we are at the year where we're going to have to stop this. So how do I come up with an easy way to determine the amount of depreciation I'm going to do this year? Well, the easy way that we're going to do this, we're going to go ahead and take our $46,800 and we're going to subtract out the $30,000, which represents our salvage value because I can't go below that. So when I go ahead and look at these two, I see that the amount of depreciation expense I can recognize this year is only going to be the $16,800, which is going to give me an accumulated depreciation of $100,000. And it gives us our book value of $30,000. You may say, what do I do with year 4 and year 5? We're done. That's why this is an accelerated depreciation method. In this case, we've gotten to year 3 and we're all done. The last method that we're going to do is units of production. This can be used for any piece of equipment where we go ahead and measure the uses of it. So think of a truck. We measure it in how many miles it used. Perhaps we have a stamping machine and how many impressions it used. Each of these pieces of equipment have a specified lifetime or an estimated life. So we're going to end up coming up with a cost for each one of those impressions, if it was a stamping machine, or miles if it was a truck. So let's go ahead and see how we would do that. For this one, I'm going to go ahead and do the math down below here. So we are referring to the information that was at the top of the sheet. We saw still that our historical cost was the $130,000. And our salvage value is $30,000, meaning that our depreciable base is $100,000. That $100,000 is still going to be the amount that we're going to use to come up with our per unit cost. So we're going to take our $100,000. I'm just going to draw an arrow so we know where that's coming from. And this is going to be divided by the useful life. In our case, we expected to have 125,000 miles for this truck. So when I take that $100,000 and I divide it by my 125,000 miles, I'm going to end up with 80 cents per mile is what the depreciation cost on this vehicle is. So again, I'm going to go ahead and use the computation column on this one. We're going to go back to the problem for C. Assume that the truck was driven 20,000 miles in the first year, 40,000 in the second, 10, 30, and 30 in the subsequent years. So I know that my depreciation rate is 80 cents per mile. I'm going to multiply that in the first year by the amount of miles driven, which was 20,000. That's going to give us a depreciation expense of $16,000. Just like before, the first year that we're recognizing it, we have no prior accumulated depreciation. So we only have the total amount we're recognizing this year. In our book value, we're going to take our 130,000 historical cost, subtract out the accumulated depreciation of 16,000, and we end up with a book value of $114,000 at the end of year 1. Following the same process, we're going to move on to year 2. 80 cents per mile multiplied by our 40,000 miles in year 2. That's going to give us $32,000 of depreciation expense. My accumulated depreciation, again, is when we are adding all the depreciation we've recognized so far. So previously I had 16, now I have an additional 32. My accumulated depreciation for year 2 is going to equal $48,000. And we see our cost over here on the side, historical cost, subtracting out our accumulated depreciation, and we end up with a book value of $82,000. Moving on to year 3, we're sticking with those 80 cents multiplied by 10,000 miles in year 3 is going to give us a depreciation expense of only $8,000. We add that to the prior year's accumulated depreciation, and we end up with $56,000 of accumulated depreciation. We follow the same process to determine book value, and we will end up with our $74,000 for book value. Year number 4, the part that stays constant is our rate, our 80 cents, multiplied by 30,000 miles in year 4 is going to give us a cost of $24,000. Adding that to our prior year's accumulated depreciation, we are going to end up with $80,000 of accumulated depreciation, leaving us with a book value of $50,000. Now I'm going to stop on this one because this is where it gets a little bit similar to our declining balance method. We can't depreciate this asset below its salvage value. So we're going to have to determine at what level do I stop. So let's go ahead and take a look at that. I'm going to just draw out the two options right here. Similar to declining balance, with units of production, we have to stop at the salvage value. So when we start getting close, we're going to have to evaluate, can I recognize the full depreciation based on my rate that year? Or do I have to stop it at a level that would put us at our salvage value? So let's go ahead and take a look at those. So if we're seeing what is left, our current book value is $50,000. And I know that my salvage value is $30,000. This would tell me that I can only recognize an additional $20,000 of depreciation. Now, if I looked at the mileage, we have 80 cents is our rate multiplied by our 30,000 miles, which is this second 30,000 miles up here, which is going to give us $24,000. In this case, I have to evaluate which one is the lesser. I have to take the lesser of these two. So I'm going to go ahead and take this $20,000. So that's the math I'm going to show in my computation. We've got $50,000 currently of our book value, subtracting out the $30,000 salvage value, means the depreciation expense we're going to recognize this year is only the $20,000. My accumulated depreciation, adding that to the prior years, we're going to end up with $100,000 of accumulated depreciation and a book value of $30,000. And that's how we go ahead and do depreciation 3 different ways. Hope to see you again soon.